Imagine seeing your account being loaded every month with $9,000 from dividend income, not from grinding longer hours or chasing risky stock picks, but from smart, consistent ETF investing. Dividend ETFs are one of the most powerful wealth-building tools, offering both passive income and long-term financial independence. As Warren Buffett wisely said, games are won by players who focus on the playing field, not by those whose eyes are glued to the scoreboard. In other words, true success comes not from obsessing over short-term market noise, but from executing the right strategies with patience and discipline. In this video, I'm going to reveal 3 unique dividend ETF investing strategies designed to help you achieve consistent cash flow while building real wealth. Whether your goal is stability, aggressive growth, or a balanced blend of both, these strategies can unlock yields that reach as high as 12% annually, transforming the way you think about investing. If you're serious about achieving financial freedom, generating passive income, and building a portfolio that works harder than you do, stay tuned. By the end, you'll know exactly how to position yourself to generate $9,000 per month with dividend ETFs. Before we continue, please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. In addition, all projections in our content are based on historical returns, growth rates, and performance. But also remember that past performance does not guarantee future results. Always consult a qualified financial professional before making any investment decision. Every investment involves risk. Welcome to Trailblazers Mindset, where wealth builders come to get inspired. Let's dive in. Now let's dive into the 3 unique monthly dividend ETF strategies, each crafted to align with different investor needs and levels of risk tolerance. The first is the conservative strategy, often referred to as the sleep well at night portfolio, which yields steady returns of approximately 4% to 5% while maintaining maximum stability and minimal volatility. This option is built for risk-averse investors, or those nearing retirement, who want to preserve capital while still enjoying a reliable monthly income. The second is the balanced strategy, which represents the middle path with yields ranging from 5% to 8% along with meaningful growth potential, making it an excellent choice for investors who want strong current income without giving up future wealth building opportunities. The third option is an aggressive strategy, designed for maximum income generation with yields between 8% and 12%, offering a dramatically higher monthly cash flow for investors willing to accept more volatility. Each of these strategies relies on a carefully chosen mix of ETFs with staggered payment schedules, ensuring that income flows in every month rather than quarterly, transforming dividend investing into a consistent paycheck-like system that removes the uncertainty of irregular payments. Now let me introduce you to the 5 carefully selected ETFs that will serve as the foundation for these wealth-building strategies. First, we have the J.P. Morgan Equity Premium Income ETF, ticker symbol JEPI, which I consider the crown jewel of income-generating investments. As of May 1, 2025, JEPI delivers a current dividend yield of 8.22%, with an expense ratio of just 0.35%, paying dividends monthly around the 5th of each month. What makes JEPI truly special is its unique dual approach to income generation. The fund invests primarily in low-volatility S&P 500 stocks, while simultaneously selling covered call options to generate additional premium income. This strategy creates remarkable stability combined with high yield, making it perfect for investors who want substantial income without excessive risk. The fund's top 3 sector allocations include finance at 17.58%, health technology at 12.12%, and technology services at 11.63%. Providing excellent diversification across defensive and growth sectors. Our second powerhouse is the J.P. Morgan Nasdaq Equity Premium Income ETF, ticker symbol JEPQ, which I like to call JEPI's more aggressive cousin. As of May 1, 2025, JEPQ delivers the highest yield in our entire lineup at 12.09%, with the same low expense ratio of 0.35% and monthly payments around the 8th of each month. The fund sector allocation heavily favors technology services at 30.26%, electronic technology at 28.31%, and retail trade at 11.45%. This concentration in high-growth technology sectors explains the higher yield, but also introduces additional volatility that investors must consider carefully. The third cornerstone of our strategy is the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD, which provides quality dividend growth with a current yield of 4.09% and an incredibly low expense ratio of just 0.06%. SCHD pays quarterly dividends in March, June, September, and December, making it a favorite among dividend growth investors who want a perfect blend of current income and dividend growth potential. The ultra-low expense ratio means more money stays in your pocket instead of going to fund management fees. SCHD's top 3 sector allocations include consumer non-durables at 17.60%, health technology at 14.62%, and energy minerals at 14.32%, providing exposure to stable, mature companies with long histories of consistent dividend payments and growth. Our fourth ETF is the iShares Core High Dividend ETF, ticker symbol HDV, which provides blue-chip stability with a current dividend yield of 3.85% and an expense ratio of 0.08%. HDV pays quarterly dividends in March, June, September, and December, offering modest but reliable yields backed by some of America's most established companies. The fund focuses on high-quality dividend-paying stocks with strong financial fundamentals and sustainable payout ratios. HDV's sector allocation includes energy at 23.47%, healthcare at 19.12%, and utilities at 15.38%, providing excellent exposure to defensive sectors that tend to perform well during economic uncertainty while maintaining attractive dividend yields. SPHD's sector concentration includes finance at 28.06%, utilities at 21.16%, and consumer non-durables at 18.02%, providing significant exposure to defensive sectors that typically maintain stable earnings and dividend payments even during economic downturns. Now let's dive into our strategy number 1, the conservative monthly income approach. Our conservative strategy is specifically designed for investors who prioritize capital preservation and steady income above all else, making it ideal for risk-averse investors or those already in retirement who cannot afford significant portfolio volatility. With a $100,000 initial investment, this strategy allocates 40% or $40,000 to HDV, 30% or $30,000 to SCHD, 20% or $20,000 to SPHD, and 10% or $10,000 to JEPI. Despite the conservative nature of this approach, the portfolio still generates a respectable 4% yield while providing substantial downside protection during market turbulence. The growth projections for this strategy are impressive when you consider the power of dividend reinvestment over time. After 10 years, your portfolio would be worth approximately $191,000, producing annual income of $7,640 or $637 monthly. The truly exciting projections come when we look at the 20-year mark, where your portfolio would reach approximately $365,000 in value, generating $14,600 annually, or $1,200 monthly. At the 30-year mark, the conservative strategy would produce a portfolio worth approximately $699,000, generating $27,960 annually, or $2,330 monthly. This strategy proves ideal for retirees and conservative investors seeking stable income with minimal volatility, while still achieving meaningful wealth building over time. Before we continue, if you find value in this video, even if just a little, please subscribe to help us continue to create top-notch educational content. We appreciate your support. Thank you. Next, let's dive into our strategy number 2, the balanced monthly income approach. Our balanced strategy represents the perfect middle ground, offering the best of both worlds by combining strong current income with excellent growth potential. This approach works exceptionally well for investors who want substantial monthly income but aren't willing to sacrifice all future growth opportunities. With a $100,000 initial investment, this strategy allocates 30% or $30,000 to JEPI, 30% or $30,000 to SCHD, 20% or $20,000 to HDV, 10% or $10,000 to SPHD, and 10% or $10,000 to JEPQ. This carefully balanced allocation creates a total average yield of approximately 5.9%, producing $5,900 in annual dividend income or $492 in monthly dividend payments from the very beginning. This middle path approach creates a well-rounded monthly dividend portfolio capable of adapting to changing market conditions, while generating nearly 50% more income than the conservative strategy. The growth projections for the balanced strategy become truly exciting when we examine the long-term potential. After 10 years, your portfolio would grow to approximately $211,000, producing annual income of $12,660 or $1,055 monthly. The 20-year projection shows a portfolio worth approximately $446,000, generating $26,760 annually or $2,230 monthly. Now my favorite, at the 30-year mark, the balanced strategy would create a portfolio valued at approximately $942,000, producing $56,520 annually or $4,710 monthly. This balanced approach works exceptionally well for investors 5 to 15 years from retirement who want meaningful growth but also need to start building substantial income streams for their future financial security. Now it's time for the strategy number 3, the aggressive monthly income approach. This strategy is designed for investors who prioritize maximum current income above all other considerations. The aggressive approach tilts heavily toward high-yield options to maximize immediate cash flow generation. This strategy works best for investors who need substantial immediate income or have significant capital from other sources, with the aim of maximizing their monthly cash flow from their dividend portfolio. With a $100,000 initial investment, the aggressive strategy allocates 40% or $40,000 to JEPQ, 35% or $35,000 to JEPI, 15% or $15,000 to SCHD, and 10% or $10,000 to SPHD. This allocation creates a total average yield of approximately 8.7%, which translates to $8,700 in annual dividend income or $725 in monthly dividend payments from the very first month. This approach more than doubles the yield of our conservative strategy but comes with higher volatility due to the larger allocation to covered call ETFs. The increased allocation to JEPQ and JEPI dramatically increases current income at the expense of some long-term growth potential, making it perfect for investors who need immediate high cash flow or those who have other growth-oriented investments in their overall portfolio. The growth projections for the aggressive strategy are remarkable when you consider both the high current income and the compound growth over time. After 10 years, your portfolio would grow to approximately $232,000, producing annual income of $20,160 or $1,680 monthly. The 20-year projection shows a portfolio worth approximately $539,000, generating $46,899 annually or $3,908 monthly. Now my favorite, at the 30-year mark, the aggressive strategy would create a portfolio valued at approximately $1,253,000, producing $108,961 annually or $9,080 monthly. This strategy demonstrates how focusing on maximum current income while maintaining reasonable diversification can create substantial wealth over time. The power of dividend reinvestment cannot be overstated because it acts as a secret wealth accelerator that fuels long-term growth. All of the growth projections in these strategies are based on the assumption that dividends are consistently reinvested during the accumulation phase, and that each portfolio achieves realistic growth rates aligned with the historical performance of the underlying ETFs. The conservative strategy is modeled on an annual growth rate of 6.7%. The balanced strategy assumes 7.7%, and the aggressive strategy is projected at 8.7%. These percentages are not arbitrary. They reflect the weighted historical performance of the ETFs in each portfolio, with SCHD alone delivering an impressive 10-year average return of about 10% annually. Reinvesting dividends allows each payout to purchase additional shares automatically, which in turn generate their own dividends, creating a cycle of compounding that becomes increasingly powerful over time. This process also delivers the benefit of dollar cost averaging, since reinvested dividends are consistently buying more shares, regardless of short-term price fluctuations, and it requires no additional effort from the investor. The path to financial freedom doesn't have to be complicated or uncertain. With the right monthly dividend ETF strategy, you can turn your investments into a reliable paycheck that arrives every single month, no matter what the stock market is doing. Over time, even a $100,000 portfolio has the potential to grow into a powerful income machine, delivering thousands of dollars every month. This isn't just about money. It's about peace of mind, independence, and control over your future. The opportunity is in front of you, and the only step left is deciding to take action. If you're serious about building real wealth, then consider this channel as your financial gym. Every video is a workout for your portfolio, your mindset, and your money skills. If today's video helped you level up your financial education, even just a little, please smash that like button and subscribe so we can continue to grow and build wealth together. Please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. In addition, all projections in our content are based on historical returns, growth rates, and performance. But also remember that past performance does not guarantee future results. Always consult a qualified financial professional before making any investment decision. Every investment involves risk. Click on the next video on your screen. We appreciate your support. Thank you.